This is your LMAX Exchange technical update for Tuesday, February 21st, 2017. Euro dollar. So the euro continues to be pressured to the downside after the market stalled out ahead of key resistance at 107.15, and the focus now is on a retest of that 14-year low from January at 103.41. Look for a break below key support on a short-term basis, which comes in at 105.22. That's the low from February 15th to strengthen this outlook and accelerate declines. Again, only back above 107.15 will negate the current bearish outlook. Sterling dollar. So cable has been slowly trading lower after recently stalling out ahead of critical resistance in the form of the December 2016 peak at 27.75, and this keeps the overall pressure on the downside, with the market at risk for a fresh drop back towards the range lows, which come in under 120. Of course, that 30-year low, that plus 30-year low from October 2016 is at 118.41, and earlier this year we got down as low as the 119s. So if the market can establish back below recent support, which comes in at 23.47, this will accelerate declines back down towards those critical lows. At this point, again, only back above 27.75 would compromise the bearish outlook. Dollar yen. So dollar yen has traded up in recent trade over the past couple of sessions, but overall the market still is favored to the downside, with rallies expected to stall out ahead of the next downside extension below recent support at 111.59 and towards a measured move objective at 109.50 further down. Only back above 115.62, the high that we saw on the 19th of January, would compromise this bearish outlook. Euro Swiss. So Euro Swiss has seen a bearish consolidation over the past several sessions. The bearish consolidation has taken the form of a descending triangle, and this projects fresh downside through the 2016 base at 106.24 and towards 105 further down. At this point, only back above 107.60 would compromise this bearish outlook. Aussie dollar. So Aussie is finally showing signs of stalling out in 2017 after a very impressive run up towards critical medium-term resistance in the 78 area. Of course, the market will need to establish back below 76 to strengthen the possibility for the market to roll over and see an acceleration of declines. Only back above 78 would force a shift in the outlook and open the door for the possibility of fresh upside in Aussie dollar. But again, while the market holds below 78, there is risk after this, especially after this impressive run in 2017, for a fresh drop on a break below 76. Dollar CAD. So dollar CAD has done a really good job being supported in the 130 area over the past several sessions, and there looks like the market is wanting to trade back higher now. A push back above recent highs from the 7th of February at around 132.13 would strengthen this outlook and accelerate towards next key resistance in the form of that high from the 20th of January at 133.88 further up. Only back below 129.69, that's the low that we saw back on the 31st of January, would compromise this outlook. Kiwi dollar. So Kiwi continues to show signs of the formation of a major top going back to the 2016 high just shy of 75. The market has recently stalled out in 2017 at 73.76, and a break and close below recent support at 71.34, 71.35 will strengthen the outlook and accelerate declines back towards next key support in the form of the lows that we saw back in the late December around the 69.12 to 69.13 area. SPX 500. The S&P 500 has traded up to a fresh record high on Monday. The market continues to trade to record highs and is showing no signs of any real let-up just yet. However, daily studies are tracking an overbought territory, significant overbought territory, and we could soon see the start or the onset to a short-term correction. But a break and close at a minimum back below 23.38, 23.39 will be required to strengthen this possibility and open the door for at least a minor correction in the S&P 500. Gold. So gold has seen a little bit of a pullback over the past couple of sessions, but overall this market is pretty constructive as it continues to show signs of fresh higher lows and higher highs. The most recent higher low is at 1180 following the break above 1220, which exposes a move towards 1260 in the days ahead. Only back below 1180 would compromise this outlook, and dips down towards 1200 should be used as formidable opportunities to buy this market.